Hello and welcome to Fire My Mortgage. Today's presentation is brought to you by firemymortgage.com because life is better without one. My name is James Murphy and I will be your narrator today. Pleased to meet you. How would you feel if someone told you that you could pay off your home in a fraction of the time and do so without changing your current lifestyle? Seriously, how would you feel? What would you do differently? Do you believe that people can live differently if they learn how to do things differently? Now, I know Einstein, but after 20 years of working in the financial world, I've kind of figured out how money works. I know that those who understand it win most every time, and those who don't, well, they just kind of sit around blaming a lot of people for all their problems. Today, I would like to share a proven process that many have discovered to pay off 100% of their debt in a fraction of the time. For most people, they pay off all of their debt in 5 to 7 years. That's their car loan, credit cards, student loans, business debt, medical bills, and even the mortgage. And although we may be specifically discussing the mortgage, it includes all of the above. And since time is money, they simultaneously save tens of thousands of dollars that otherwise would have gone out the window in the form of interest payments. And please don't miss that. This specific strategy is often shaving off 15 to 20 years or more from the mortgage. It's not uncommon to see people saving $75,000 to $100,000 or more, and that's money that otherwise would have gone out the window in the form of interest payments. And this is not rare. Across America, hundreds of thousands of homes are being paid off this way. Now, I'm not saying that this is right for you, but if it is, this might very well be the most important financial video you ever watch. And besides interest, another savings that really adds up is the PMI. As soon as you start this process, you no longer have to make those monthly bill payments for PMI. I'd rather see as much of your cash flow working for you as possible. Now, in case you don't know, PMI stands for private mortgage insurance. This protects the bank in case you default on the loan. It protects them, not you, although you still have to make the premium payments. And this is different than your homeowner's insurance that protects in the event of hail, fire, or wind. Before we begin, let's discuss what this is not. This is not living on beans and rice. Great with your burritos, terrible as a financial plan. It's not selling everything you own. It's not a get-rich-quick program. It's not a schedule that locks up your money. This is not a systematic making of extra payments monthly or annually. People who do that, they have good intentions and it gets them a little bit ahead, but the math shows that it does not make a sizable impact. It cuts a couple of years off the end of the mortgage, assuming they stayed in the original loan and never refinanced. But for most people, they simply feel more broke and are still strapped by a lifetime of mortgage payments. What this is, it's a more efficient way of eliminating debt. It is a proven system utilizing math and logic. It's a process that uses bank products with which you're already comfortable, and it is a quicker path to financial freedom than most people have ever known. To further illustrate, allow me to introduce you to two friends of mine, Mike, the handsome Mike, and Mimi, the lovely Mimi. The two recently met, they fell in love, got married, and because they wanted to save up for a down payment on their home, they moved into an apartment. Well, the walkthrough didn't really indicate what apartment life would be like. The barking dog at 2 a.m, the fighting neighbors at 3 a.m, and all day long smelling everybody else's food. This was not their dream come true. But soon thereafter, they welcomed baby into the family. Congratulations, Mike and Mimi. Pretty quickly, they started dreaming of buying their first home. It didn't take long for Mike and Mimi to find the home of their dreams. They purchased the average price home for $200,000. They obtained an interest rate of 4% and spread that out over 30 years. Pretty typical story. Also very typical were the bills, and more bills. And with those bills came a whole lot of stress. And with that stress came a few arguments. Like I said, a very typical story. One day Mike was surfing around and landed on firemymortgage.com. There he discovered how homeowners are paying off their homes much more quickly than planned, and doing so without resorting to living on beans and rice. It almost seemed too good to be true, but he read the true testimonies of others, and what he was doing certainly wasn't working. So he picked up the phone and dialed 833 Fire My Mortgage. Hello, this is James Murphy. How may I serve you? Mike shared a bit what was going on. James certainly empathized, but then shared with Mike that he likely didn't have a problem with his marriage, but that he might have a very real problem with math. That day, Mike learned 3 valuable truths. First, nearly 70% of his monthly payment went to interest. The second thing he learned that in the first 10 years, he would pay almost twice as much in interest as he would pay himself in principal. The third thing that Mike discovered is it will take 23 years before he has finally paid himself in principal what he has already paid to the bank in interest. That's a 23-year break even. If this were an equitable relationship on a 30-year note, wouldn't that break even be somewhere around 15 years? Mike also found it weird that the word mortgage comes from the same word as mortality, morbid, mortician, mortuary, amortization. The word mortgage literally means death pledge. Mike, if I could show you and Mimi how to pay off your mortgage and all your debt in a fraction of the time and consequently saving tens of thousands of dollars in interest, would you be interested? Well, I guess I'd be silly to at least not hear you out. Mike, we need to schedule a time when both you and Mimi can both be present. It's super important for both of you to understand how this works and that both of you are on the same page. Now, Mike hadn't been married long, but he understood how important that was. Oh, and one request, James added. I will send you a confidential questionnaire asking about your numbers. This is such an important decision. It's imperative that we accurately discuss your situation. Most people can benefit, but not everyone. Would you be able to get that back to me at least 24 hours before our meeting? Mike and Mimi excitedly got right on that because finally there was some hope for their financial future, and they got that back to James the day before the meeting. At that next meeting, James happily explained the difference between a traditional mortgage, which they had, and a revolving credit mortgage that can more efficiently pay off the home and other debt. The revolving mortgage acts like a mortgage and a checking all at the same time. You see, one of the challenges with a traditional mortgage is that they are closed-end types of debt. That means that if you make extra payments to them, you cannot get that money back unless you sell or refinance with a cash-out option. Mike kind of remembers seeing something like that in the Truth in Lending statement. Revolving mortgages, on the other hand, are revolving mortgages. That means that you can put your money in, you can take it out. You're not penalized for doing it too often. You're not required to do it a certain number of times. Anytime, 24/7, as they say, you have access to your money. But the longer it stays in there, the more benefit it has on your financial future. Until now, Mike and Mimi were hesitant to put too much on their mortgage for fear that something might happen. It was their emergency fund after all. Mimi spoke up. So, if we have access to our cash at any time, why wouldn't we just throw our savings on our house debt while we're not using it? We get a pathetic rate of return on our savings anyway. You're quick with money, Mimi, James replied. I'm kind of thinking the same thing. Equally as powerful as you're parking your savings, knowing that you can get it back anytime, you can park 100% of your income on your house debt. So instead of $300 to $500 going towards your principal like it does now, your $3,000 to $5,000 of income can go towards it. How quickly would your loan balance go down if you could throw that much at it? This is called paycheck parking, and you only pay simple interest instead of compounded, and all your interest is calculated daily, so every day it's in there, you pay less towards interest and more towards your principal. Wait right there, James Murphy, Mike quickly interrupted. This all sounded fine and dandy until you got there. We need that money for gas and food and bills. How are we supposed to paycheck park and use that money to pay bills at the same time? You're a smart money man, Mike. You are correct. Money cannot be in two places at once. That's why we'll show you how to use another bank's money for free while your savings and income are being best used to destroy your debt. This is called interest floating. Mimi chimed in. Oh, that's like using a rewards card to earn travel and cash when making ordinary purchases? I've been listening to podcasts about the FIRE movement. Financial independence, retire early? Yes, Mimi replied. And they've been encouraging me to do just that, but I was afraid that our spending would get out of control if we did. I am so glad to hear you say that. This is not for people who are out of control with their spending and care less about the consequences of their purchases, people who can't control what they put in their shopping carts. This is for people who want to be financially fit, who seek financial independence, and who are ready to live life on their terms. Mimi, are you stretching? Yes, we're ready for the workout. Jumping in, Mike said, yes, we both want this to work out, but first, what are the downsides? Yes, I was just about to cover that. Thank you for bringing that up. The most important thing we've already covered, and that is that you cannot spend more than you make. You don't have to spend less than you're currently spending, but you will have access to more cash than you may have ever seen before. And some people cannot handle that. But I've got a good feeling about the two of you. And people need to have decent credit. For sure in the mid 600s, but over 700 is better. Mike nodded and said, okay, we're good on all those things, but I'm not really wanting to replace my current mortgage. We have a pretty good interest rate. James replied, I completely understand, Mike. First thing I just want to say is that interest rates have very little impact on the outcome of the strategy. See, the banks have trained us so well to look at the interest rate all the time, ignoring time. And time is actually the most powerful dynamic of how money operates. To prove this, look at when interest rates go down by 0.5%. The multitudes flock to the lender to refinance their loan, ignoring the fact that they're starting that front loading of interest all over again and that they'll likely pay on this for the rest of their lives. But people who are following the Fire My Mortgage method typically pay off their homes so quickly that rising interest rates add only a few months. And a few months when they're saving 20 years and tens of thousands of dollars in interest doesn't make rising interest rates much of an issue. That said, we have several different strategies, and only one of them actually replaces your first mortgage. We take the time to evaluate your unique situation from all angles to determine which strategy makes the most sense mathematically and mentally. Then, and only then, will we make a fiduciary level recommendation that's in your best interest. But the point is, you do not have to replace your current mortgage in order to fire your mortgage. Also, every financial decision has expenses associated with it, and so there are closing costs and there are coaching costs. Fire My Mortgage is not affiliated with any lender, and thereby we're not remunerated by these lending institutions. The closing costs secures your loan. The coaching cost is for us to introduce you to the strategy, to analyze your unique situation, to create the payoff reports, to introduce you to the lender, to do the application, to help you to get qualified, to open up our reference library, to assist you on your journey, and to walk you through all of the complexities of your situation till you are 100% debt free. By the time we have done this, we will have spent many hours together working through the details of your situation. And so I just want to say closing costs are never cheap. But Mike and Mimi, let me ask you this. If you had to spend $5,000 to save $50,000, would that make financial sense? Now, I'm not saying those are your numbers. I'm just saying if you had to spend a smaller amount to save a much larger amount, would that be logical? We have covered a lot of nerdy stuff, many facts. But one thing I knew from talking to you is that there was a lot of stress going on in the marriage. There were many sleepless nights and a lot of worrying about how you're going to make ends meet and how you're going to reach your financial goals in time. So I just want to stop all the nerdy stuff just for a minute and ask, what if? What if you had your emergency money? And then what if your house was paid for so much sooner than planned? And what if your medical bills were taken care of and you were saving and preparing for retirement like you wanted to, and your car's paid for, and you carry no credit card balance from month to month? And what if you could actually pay for your kids' college because your own student loans were wiped out? What if? What would that feel like? The reason I say that is the objective of this new plan is not just to destroy debt as quickly as possible, but to help you save like never before and to protect the plan. So the goal of savings is so that hopefully you never have to borrow again. The goal of protecting is if things don't go according to plan, you still have a plan for everything to be fulfilled according to your wishes. So even if you need chronic care, critical, terminal care, or if you die too soon, it's like you are still being there, being the best version of yourself, even when you cannot be. These are all conversations that we can integrate into the plan so that you're not just accomplishing one goal, but many. All right, anybody in this meeting ready to win with their finances? I will send you a complete report that based on your income, expenses, and amount of debt you have, you will know exactly how long it will take you to be 100% debt-free and see how much interest you will potentially save. Our next step is introduce you to the lender. Now, there are only a couple of banks that check all the boxes to do a program like this. So I will ask that when you talk to your friends, and you will talk to your friends because it will be so exciting, please don't mention the name of the bank. For one, we might use a different bank for them. And two, I want to make sure that people don't make things worse by trying to do these things on their own. If you have not already saved my number in your phone, please feel free to do so. You can call or text 402-590-2020, or you can email at help@firemymortgage.com. I assume you'll have questions. Please let me know when you have time to discuss your situation in detail. It has been an absolute pleasure to spend this time with you. Thank you for watching Fire My Mortgage, because life is better without one.